Imagine a world where the largest foreign holder of U.S. Treasury securities suddenly decides to offload a staggering $70 billion worth of U.S. debt. That's exactly what Japan, the long-standing ally and economic powerhouse, is poised to do. This move has sent shockwaves through the global financial markets, leaving investors and economists alike scrambling to understand the implications for both economies. But what's really driving this seismic shift in investment strategy, and what does it mean for the future of the Japanese yen and the U.S. economy? The Japanese yen has been on a wild ride, with its value fluctuating against the U.S. dollar like a ship caught in a storm. For savvy investors, this volatility has presented both challenges and opportunities. As the yen weakened, Japanese equities soared to record highs, buoyed by the favorable exchange rate. But now, the tide is turning, and the yen is showing signs of strengthening. Will this be the calm after the storm, or is there more turbulence ahead? Masahiko Liu, a senior fixed-income strategist at State Street Global Advisors, believes that despite the risks a stronger yen poses to corporate profits, there are still sufficient benefits from the yen trading around the 156 mark against the dollar. Peter Perkins, a partner at Macro Research Board Partners, points out that even though the yen remains relatively undervalued, the shift from 163 to 147 serves as a reminder that changes can happen quickly. As investors navigate these uncharted waters, they must remain vigilant and adaptable, ready to seize opportunities as they arise. The yen's volatility has not been limited to its relationship with the US dollar. The currency has also experienced significant fluctuations against other major currencies, such as the euro and the British pound. These movements have added an extra layer of complexity for investors seeking to diversify their portfolios across multiple currencies. As the global economic landscape continues to shift, the yen's role as a safe haven currency has come under scrutiny, with some analysts questioning whether it can maintain its status in the face of mounting challenges. Despite the uncertainty surrounding the yen's future, many investors remain optimistic about the opportunities presented by the Japanese market. The country's strong economic fundamentals, coupled with ongoing corporate reforms and a supportive policy environment, have made Japanese equities an attractive proposition for both domestic and foreign investors. As Tomo Kinoshita, a global market strategist at Invesco, notes, "Over the coming months, I expect that a considerable rise in wages will lead to a moderate rise in Japan's private consumption, which should benefit Japan's domestic demand-related stocks as investors become more confident of Japan's long-term growth on the back of virtuous cycle between wages and prices." However, investors must also be mindful of the potential risks associated with the yen's volatility. Sudden shifts in the currency's value can have a significant impact on the performance of Japanese equities, particularly those with a heavy exposure to export-oriented sectors. As Vincent Chung, an associate portfolio manager at T. Rowe Price, cautions, "The depreciation of the foreign exchange makes it more likely that the BOJ will hike rates in July. This could put pressure on bond yields to move up in Japan." Investors must carefully consider these factors when making investment decisions and be prepared to adapt their strategies as market conditions evolve. Japan's decision to dump $70 billion in U.S. debt is not just a ripple in the pond. It's a potential tsunami that could reshape the global economic landscape. As the U.S. government grapples with multi-trillion-dollar annual deficits and rising interest rates, a sudden increase in the supply of treasuries could exacerbate the problem. If Japan starts unloading its U.S. treasuries, it would be equivalent to a margin call on the U.S. Treasury Department, as noted by the Heritage Foundation. The potential consequences are alarming. Higher yields on U.S. treasuries could lead to increased borrowing costs for the U.S. government and higher interest rates across the economy. With the Treasury Department already spending record amounts on interest payments, a Japanese fire sale of U.S. debt could push the annual interest on the federal debt to $2 trillion and beyond. This domino effect could have far-reaching implications not just for the U.S., but for the entire global economy. the ripple effects of Japan's move could extend far beyond the U.S. Treasury market. As one of the world's largest economies and a major player in global trade, Japan's actions have the potential to influence financial markets and economies around the world. A significant shift in Japan's investment strategy could lead to increased volatility in currency markets, as the demand for the yen and other currencies fluctuates in response to changing capital flows. Moreover, Japan's decision to reduce its U.S. Treasury holdings could signal a broader trend of diversification away from the U.S. dollar as a reserve currency. If other countries follow suit and begin to reduce their reliance on the dollar, it could have significant implications for the global financial system. The dollar's status as the world's primary reserve currency has given the U.S. significant economic and political leverage, and a shift away from the dollar could erode that power over time. Furthermore, Japan's move could have spillover effects on other asset classes and markets. As Japanese investors repatriate their capital, they may seek to invest in other assets, such as domestic equities or real estate. This could lead to increased demand and potentially higher prices for these assets, creating new opportunities and risks for investors around the world. Additionally, if Japan's actions contribute to a broader shift in global capital flows, it could have implications for emerging markets that have relied on foreign investment to fuel their growth. Despite the challenges posed by a strengthening yen, foreign investors remain bullish on Japanese equities. The shift in the yen's trajectory is expected to favor international investors who have been eyeing the Japanese stock market. As the yen appreciates, foreign investors will be able to realize gains from the Japanese market more effectively. Bank of America anticipates that the Japanese stock market will achieve a full recovery by late September or October, predicting that the market will be trading near its March highs by year's end. Peter Perkins advises investors to gradually increase their exposure to Japanese equities now, rather than waiting for greater stability in the yen. But is Japan truly a beacon of opportunity, or are there hidden risks lurking beneath the surface? One of the key factors driving optimism in the Japanese market is the country's ongoing commitment to corporate governance reform. The Japanese government has been actively promoting initiatives to improve transparency, accountability, and shareholder value in the corporate sector. These efforts have been well received by international investors, who see them as a positive step towards aligning the interests of companies with those of their shareholders. Moreover, Japan's unique position as a global leader in innovation and technology has made it an attractive destination for investors seeking exposure to cutting-edge industries. From robotics and artificial intelligence to renewable energy and healthcare, Japanese companies are at the forefront of many of the world's most exciting and transformative sectors. As these industries continue to grow and evolve, investors in Japanese equities stand to benefit from the potential for significant long-term growth. However, it is important to recognize that investing in Japan is not without its risks. The country's demographic challenges, including an aging population and low birth rates, could potentially limit economic growth and strain social welfare systems in the coming years. Additionally, Japan's reliance on global trade leaves it vulnerable to geopolitical tensions and economic downturns in other parts of the world. Investors must carefully consider these factors when assessing the potential risks and rewards of investing in the Japanese market. Despite these challenges, the overall outlook for Japan as an investment destination remains positive. With a supportive policy environment, a strong commitment to corporate governance reform, and a leading position in key industries of the future, Japan offers a compelling opportunity for investors seeking to tap into the potential of the world's third-largest economy. As the land of the rising sun continues to shine, savvy investors will be watching closely to see how this dynamic and evolving market unfolds in the years ahead. As investors navigate the complex world of global finance, they must constantly balance risk and reward. Japan's decision to reduce its U.S. Treasury holdings presents both challenges and opportunities, and those who can adapt quickly will be best positioned to succeed. Daniel Blake, a strategist at Morgan Stanley, notes that in Japan, we see above consensus earnings of 10–11%, supported by nominal growth and corporate reforms, which we believe will not be disrupted by recent volatility. However, he also cautions that external shocks or threats to either the Japanese economy or global growth could jeopardize this outlook. Peter Perkins echoes this sentiment, stating that while such risks are a possibility, we don't see any reason to believe it will happen. It's a wild card, and you can't base an investment strategy on constantly worrying about wild cards. One of the key considerations for investors seeking to balance risk and reward in the Japanese market is the potential impact of currency fluctuations. While a stronger yen can benefit foreign investors by increasing the value of their holdings, it can also pose challenges for Japanese exporters by making their products more expensive in global markets. Investors must carefully monitor these dynamics and adjust their strategies accordingly to optimize their returns while managing potential risks. Another important factor to consider is the broader geopolitical landscape and its potential impact on the Japanese economy. As tensions between major global powers continue to simmer, investors must be attuned to the potential for sudden shifts in trade policies, diplomatic relations, and military posturing that could have spillover effects on financial markets. By staying informed and proactive, investors can position themselves to navigate these challenges and capitalize on opportunities as they arise. Moreover, investors must also be mindful of the potential for domestic political and economic shifts within Japan itself. While the country has enjoyed relative stability in recent years, there is always the potential for unexpected changes in leadership, policy direction, or economic conditions that could impact the investment landscape. By maintaining a diversified portfolio and keeping a close eye on key indicators and trends, investors can help mitigate these risks and position themselves for long-term success. Ultimately, the key to navigating risk and reward in the Japanese market is to maintain a disciplined, data-driven approach that is grounded in a deep understanding of the underlying fundamentals. By staying attuned to the latest developments in the global economy, monitoring key indicators and trends, and adapting quickly to changing market conditions, investors can position themselves to capitalize on the opportunities presented by Japan's dynamic and evolving investment landscape. While there are certainly risks to be managed, those who are able to strike the right balance between caution and opportunism will be well positioned to reap the rewards of this exciting and transformative market in the years ahead. In a world where financial markets can change in the blink of an eye, knowledge is power. As Japan's $70 billion U.S. debt dump sends ripples through the global economy, it's more important than ever to stay informed and adapt our investment strategies accordingly. By delving into the sources listed in the description below, you can gain a deeper understanding of the factors driving Japan's decision and the potential implications for investors around the world. From the shifting dynamics of the Japanese economy to the fluctuations in the value of the yen, these sources provide valuable insights that can help you navigate the turbulent tides of global finance. One of the most important aspects of staying ahead of the curve is to maintain a global perspective. While it's easy to get caught up in the day-to-day movements of individual markets or currencies, it's crucial to understand how these pieces fit into the larger puzzle of the global economy. By staying attuned to developments in other parts of the world, investors can gain a more comprehensive understanding of the forces that are shaping the investment landscape and make more informed decisions about where to allocate their capital. Another key aspect of staying ahead of the curve is to embrace a data-driven approach to investing. In today's fast-paced and ever-changing market environment, relying on gut instincts or outdated assumptions can be a recipe for disaster. Instead, investors must be willing to dig deep into the data, analyze trends and patterns, and make decisions based on a rigorous and objective assessment of the facts on the ground. By leveraging the latest tools and technologies to gather and analyze data from a wide range of sources, investors can gain a competitive edge and stay ahead of the pack. Moreover, staying ahead of the curve requires a willingness to adapt and evolve as market conditions change. What worked yesterday may not work today, and what works today may not work tomorrow. By staying nimble and open to new ideas and approaches, investors can position themselves to capitalize on emerging opportunities and navigate the challenges of an ever-changing market landscape. This may involve reassessing long-held assumptions, exploring new asset classes or investment strategies, or even rethinking entire portfolios in light of new information or changing circumstances. Ultimately, the power of knowledge lies in its ability to empower investors to make more informed, confident, and effective decisions in the face of uncertainty and change. By staying ahead of the curve through a combination of global perspective, data-driven analysis, and adaptability, investors can position themselves to thrive in even the most challenging market environments. As Japan's $70 billion U.S. debt dump reminds us, the world of finance is always evolving, and those who are able to stay ahead of the curve will be the ones who come out on top. A call to action: seizing opportunities in uncertain times. As we've seen, Japan's decision to reduce its U.S. Treasury holdings presents both challenges and opportunities for investors. While the road ahead may be uncertain, those who stay informed and adapt quickly will be best positioned to weather the storm and emerge stronger on the other side. So, what can you do to seize the opportunities presented by this seismic shift in the global financial landscape? Start by educating yourself. Dive into the sources listed below and gain a deeper understanding of the factors at play. Then, take a hard look at your investment strategy. Are you positioned to take advantage of the opportunities presented by a strengthening yen and a resurgent Japanese stock market? If not, now may be the time to make some adjustments. But don't stop there. Stay vigilant and keep a close eye on the markets. As we've seen, changes can happen quickly, and those who are able to adapt on the fly will be best positioned to succeed. By staying informed and being proactive, you can navigate the turbulent tides of global finance and come out ahead. Japan's $70 billion U.S. debt dump is a stark reminder of the interconnectedness of the global economy and the ripple effects that can occur when major players make significant moves. As investors, it's up to us to stay informed, adapt our strategies, and make decisions based on a comprehensive understanding of the factors at play. While the road ahead may be uncertain, one thing is clear. Those who are able to navigate these uncharted waters with skill and agility will be best positioned to succeed. By staying ahead of the curve and seizing opportunities as they arise, we can not only weather the storm, but also emerge stronger and better positioned for the future. So, what are you waiting for? Dive into the sources below, educate yourself, and take action. The world of global finance is constantly evolving, and those who are able to adapt and thrive in the face of change will be the ones who come out ahead. Are you ready to navigate the turbulent tides of Japan's $70 billion U.S. debt dump? The opportunity is yours for the taking.